Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Global markets are probably at the beginning of a regime shift of sorts after a 15-year period defined by low interest rates, ample liquidity, and possibly high and cheap corporate debt as well. So does this transition as large as this uh, happen in a period of 4, 5, 6 months that we've seen thus far, or could the impact be slightly prolonged in nature and come with a bit of a lag? And what could it do in its wake and its aftermath? Let's get in Devina Mehra, who looks at global equities at large as closely as anybody I know. It'll be really interesting to get her views on the same. Devina, great having you. Thanks for joining in. Hope all is well.
Hi, Neeraj. Great to be back. And of what you said, one thing which you missed out was a long period of low inflation. That in fact is longer than 15 years for the Western economies. I'm talking about, of course, in India, periodically inflation rears its head as it does in most of the emerging markets. But for most of the Western world, it is the first time, if not in living memory, and certainly the career memory of most people who are in the markets. So they have never seen anything like this. So that has been the big shift. In fact, I was looking at how the economists' forecasts have moved over on inflation particularly, and from the beginning of 2021. And no one expected that inflation would be this persistent. So, I mean, the interesting thing was because in the US in particular, since the target is 2%, till the inflation was below 2% in January and February last year, the economists were all predicting that it will go up to 2% and then it will go down. Thereafter, after it exceeded 2%, the predictions were only of a downward slope. Every month it kept going up, and from wherever it was, the consensus would be that it would go down from there. So nobody expected that, which actually is rather strange, because the quantum of money that was pumped in was, I mean, unprecedented by probably an order of magnitude. So that is the thing. So nobody ever expected that the inflation, and therefore you're right that something which has taken a change which has happened after a decade and more. Inflation right now, for example, in US is at a 40-year high, in Germany almost at a 50-year high, in Spain again 40 years, 20 to 30 years almost across the board, including India. I mean, India wholesale price index is at a 30-year high. And not just for a month, I'm talking about the whole of the financial year. Last year, it was over 13%, which is a 30-year high. So given that, it's not going to, that it's not going to play out in a matter of a couple of months. I mean, the whole adjustment process will take long. How long? Who knows? Because I mean, people say that where will the Fed rate be, for example, which is, for example, one of the main determinants of asset prices. I mean, even Powell doesn't know where it will be, because it all depends on how the data unfolds. So everyone thinks that somebody will know, the RBI governor will know, the Fed will know, but they also don't know. Everybody has to follow the data as to how things unfold. And the inflation appears somewhat persistent. So that will be the overhang on policy and therefore on the markets also. But nothing happens linearly. That's the other part. That when you have a big fall, for example, for now we are expecting some sort of a bounce back, both in US tech and even in India. May not be as sharp as the way it happened in March 20 after the COVID crash, but definitely you will see some move up. But whether that would persist is another matter. So this is the time to be, as we always say, that don't be bearish, don't be bullish, be harish. So move fast, but be able, be willing to change direction, because life is only about probabilities. And right now, the crystal ball is less clear than at many other times when you are in the middle of a cycle that is clear.
Wow. Okay. That kind of gives us a big summary, Devina. Let me try and break it up into some pieces as I understand it. So
Sure.
The very short term, Devina, let's say, for example, this week, right? We'll have the MPC, which will arguably not sound dovish for sure, in all probability. We'll have the
Right.
ECB, which will not sound dovish. We might have the inflation print in the US on Friday, which might probably show some signs of follow-up of peaking, but who knows? So in the very short term, do you reckon these factors are, I mean, if you believe that the markets are on the bounce, do you believe these factors, which may be sounding hawkish, are already discounted in the minds of the market, or are there some other things at play?
I think, I mean, I'm not expecting big surprises. The 50 basis points is already factored in. So that will happen. Now, the question only is not that how much they will hike this time. It is like how many hikes more.
So the RBI, you mean?
So that is the part which is not known, which won't be known this week either. So in terms of inflation, when the March numbers had come out in the US, I had expected that maybe we are close to peaking, but that didn't happen in April, mainly because the shelter inflation persisted, which is the housing related inflation. And the reason for that was that people are trying to lock in mortgage rates before they rise even further. That may be playing out now because the mortgage market is probably 1.5 to 2 times from what I hear from people in the market of where it should normally be. So I mean, there's room for mortgage markets to shrink. So the inflation, not in the Eurozone, but in the US, may be somewhere in the peaking zone. But the thing is that will it fall to levels which the Fed wants? I mean, that is the thing. You're talking from 8% around that levels to 2%. It's a long way. So I don't think that's going to happen in a hurry, simply because there are a lot of the inflation is supply led, as we all know. I mean, the commodity inflation, which had started even before the Russia-Ukraine war, and where there are actual physical supply issues, so that will persist. The labor market has been on a fire in the US. So even though real wages have not been rising at that rate, but nominal wages have been rising. So I mean, Fed is trying to fight inflation expectations getting built in, and I think they will remain hawkish, even if it means hurting the economy. That is the way I read all that they say, that no matter what happens to equity or asset prices, they have to see through that the inflation comes down. So that I think will remain their stance. The only thing is that they might do these 2 hikes and then wait a while to see how with a lag the economy is impacted before doing things further. And also there is this, whether the neutral rate the Fed is looking at is 2% or 2.5% from 1% today. So that's the other part.
Okay. So Devina, if there's a lot of talk of China finally starting to open up a little bit, relaxing a little bit, if you will, and one never knows what happens there 1 week from now. But with the presumption that may continue, and if there is a part solution to the supply chain issues that the world is grappling with, could that be a bit of a green shoot, or not necessarily so?
Actually, there are 2 things to this. One is that places where China was the supply constraint, but there is also this aspect that China is also a big consumer. So it's also the demand side of China. In fact, if you look at how the year started, all commodities, I mean, pretty much were on fire, from energy, oil and gas, of course, but also things like metals and agri commodities. So agri commodities and energy have remained buoyant in terms of prices, but metals gave up all their gains. They went up 20-30% and then they came down, and the reason was the China lockdown. So if China opens, that will be the other side of the equation, that again you might see. And I don't think on the energy side you will see prices coming down anytime soon, because again, the China demand will come back, and also because of all the environmental concerns, there has been not that much investment on fossil fuels. So that's the other side of the equation. But yes, I mean, things like chips and all, and few other things you might see some. In any case, Foxconn has also said that on the chip side, the supply constraints might ease, which has been a bottleneck for quite a few industries.
Yeah, indeed. it was interesting to see Saudi Arabia raise those prices as well, right, in Asia. So it will be very interesting what happens to crude near term. So just one more slightly macro question, then I would love to understand a bit of micro from you as well. Great to do both with you. Uh, uh, the one part is inflation and interest rates. The other part is what both the US and as per what latest was said by ECB, Europe could do as well, which is the withdrawal of liquidity. Now, even if inflation were to peak, Devina, let's assume it does, and let's assume central banks are not very hawkish on the rate side, but this liquidity withdrawal, if that were to happen at an accelerated pace, does that individually have a large impact on markets and the way they behave, even if inflation were not to be a boogie?
Yes, of course. I mean, that this massive amount of liquidity, as it gets withdrawn, obviously it will have an impact on asset markets. And on the margin, you're already seeing, at least on the non-public markets, the impact has been quite significant.
Yes.
If you look at, VCs are talking a totally different tune now. So because it's no longer possible or easy to have public issues with companies saying that, we don't know whether and when we will be profitable.
True.
So you're seeing that. So I mean, that obviously will impact that, such a massive withdrawal of liquidity as it happens. Yes, it will have an impact. I mean, in the US, there's only this balancing factor of some safe haven flows coming in if uncertainty remains in the rest of the world. But I mean, even that aside, it's still a big move.
Okay. So, Devina, what is your slightly medium-term thesis? There is a camp which believes that we haven't seen earnings downgrades in a material way thus far, and we've probably seen some multiples derating. That may continue, and we might also see earnings downgrades in India, and that might lead to a bit of a corrective move, even if there was a bounce in the intermediate term, which is underway right now. What's your hypothesis?
Okay, first of all, our base case is that India will continue to outperform the globe. And part of the reason for that is that it has started outperforming only relatively recently. So 2021 was 1 year where after a very long time, India was in the top 10 markets. It was number 6 in the major markets. So which has come after like 5-10 years of being number 25 and number 21 and so on. So that might persist. But having said that, I normally don't like to give a view on index earnings because that gets distorted by just a few years. But yes, there will be pressure because the economy is under pressure. If you look at the GDP, for example, it was 8.7% last year, but that was after a 6.6% decline. So if you, in the 2 years, you've gone up only 1.5 times. But in per capita terms, you have shrunk slightly. So that is the concern. And slowly these downgrades happen. In GDP, I was looking at the budget time last year, that's Feb 21. The expectation was that financial year 21-22, the GDP will go up 11%. Every quarter, every month, even in the last quarter, we had 3 downgrades and we ended up with 8.7 instead of 11, which we started out with. So, and a very large part of the economy and the residents are hurting. That even before this kind of runaway inflation in food and fuel, you were seeing that because you look at two-wheelers volumes have been at a 10-year low. I mean, what is at a 10-year low in terms of volume? That shows that people are not migrating up the income ladder. People like you and me get isolated from it because you can call it the creamy layer is doing well. The organized sector employees are doing well. So if you look at cars, for example, entry-level cars are not doing well, but premium cars, SUVs, the growth rates are much higher. Housing, the same thing, that high-end housing doing well, affordable housing going nowhere for the last many years. So that we are, and even small things like if you look at the last quarter numbers for FMCG, volumes have shrunk. Because this kind of food and fuel, and now it's not just food and fuel, even clothing, if you look at the last number is nearly a 10% increase year on year in textile, because cotton has more than doubled and synthetic fiber has also gone up. So the household budgets have only that much room to maneuver, and especially in times when, because of various things which have happened over the last few years, in any case, people's jobs, businesses have all been hurt. So that you have to keep in mind. But as I said, having said that, there are pockets where you can find reasonable places to be in, sort of. So that is, and one other thing which has been my base case, not just from now but for over 6 months, that this year the big risk is rupee depreciation. So that has only with the war and all that, that has only become, and the crude going up has only become more imminent. So that I think sometime or the other, you've already seen some part of it, and I don't think we are done yet.
So does that at the margin, for example, help IT, or do you reckon that the case for the US recession and the impact on IT is therefore the larger overhang? What's your sense here? Because on IT, the street is split right down the middle. Would love to understand your view.
I continue to like IT. I mean,
you continue to like IT.
Yeah, we've liked it almost 2 years, a little less than that. When in 2020, when FMCG was the flavor of the month, I had said that why not IT, because that has predictable margins plus a dollar hedge, plus not as high returns as FMCG, but still reasonably high return ratios, and yet the valuations are a fraction. So big re-rating happened. Of course, this calendar year they have not done well, no doubt. But I think rupee depreciation, yes, will help. And as far as they are concerned, I think their user industries will still continue to invest in, or at least not cut back. And the other problem which had happened for them was employee costs going up. And I think we are past the peak in that. That's my, that's what my checks tell me. So that remains a sector that we are comfortable being somewhat overweight in. And as I said, the rupee part is also there.
Okay. And at the margin, do you think it helps some of the other themes as well? I mean, Q3 and Q4 of FY22, or at least Q3 of FY22, saw a lot of fanfare for those exporting themes, right? Be it textiles, be it some other pockets which are smaller in nature, but kind of came to the fore. Do you think that would continue?
I mean, broadly, yes, export and import substitutes, or so textiles is there. Capital goods also we continue to like in pockets. Chemicals you have to disaggregate a bit, because for some chemical companies the input prices have gone up, for some output prices have gone up, so you have to look at how it. So I mean, right now it is not going to be a 2021 kind of market where little less, little more, everything went up. Here you have to drill down into sectors, and often not just sectors, go below that also and look at each company as to what really, how it's getting impacted.
I reckon you are very bottoms up, Devina, but since we can't talk stocks on this forum, are there thematic ideas where you are largely very constructive, even in a scenario wherein the markets may be iffy?
Yeah, so I mean, in terms of sectors, as I said, IT services is there, certain parts of energy, certain parts of chemicals, certain parts of textiles, telecom. I think those would be the areas where we would be broadly have, we'd be overweight.
There are only 2 parts of telecom. Anyways, okay. Just final one or two questions, Devina, before we let you go. I have taken 20 minutes of your time. Just a couple of more. There's a lot of at the start of the year. There's a lot of talk about how after a 5-year hiatus, autos might make a comeback. Now we've seen the two-wheeler argument rise up and die down as quickly as well. Same with the entry-level car segment too, so to say. What's your sense for autos?
We are still watching. We are still not at a stage where we can make a call that we should be overweight. We've increased we were heavily underweight. We've increased slightly now. But I mean, it is not like an out and out buy sector. As I told you, again, this is like where different segments are doing differently. And so you have to look at it. And also, I mean, they were hurt by the metals going up, which of course now is down. The cost of having a vehicle has gone up with the fuel cost. So it's not as if that it's like a very clear runway for them yet.
Got it. My final question, Devina, what is it that you would watch out for the most over the course of the next 6 odd months for the rest of the year? It could be a combination of global factors or local factors, but what is that one thing that you would keep a keen eye out for?
I would think, inflation and interest rates, that because that has the broadest impact. And also, I would, since the food prices have gone up across the globe, that's the another thing which is of concern. Also, from a stability point of view, because historically, if you see, a lot of instability in a number of regions arises from food prices. And I sometimes tell my analysts this also, that you are looking at it as a financial asset, as something in abstract, something on a chart. But I have one of them even talking about that if it goes up, then maybe demand destruction and deflation. I said, what demand destruction in food means? It means people are starving. And when people are starving, instability comes. So that's the other part which I would like to keep an eye out for. Not something most people in the financial markets focus on, but that's so important.
Lovely as always talking to you. A slightly different discussion than what we normally do, but thank you so much for this and look forward to talking to you more often, Devina.
Great, Neeraj. Always a pleasure talking to you.
Thank you so much. And viewers, thanks for tuning in.